What if a single country sitting at the crossroads of Europe and Asia could shake global shipping lanes, energy pipelines, and even international politics simply by closing its ports and skies? That's exactly what's happening right now with Turkey. In response to Israel's military campaign in Gaza, Ankara has pulled a dramatic move, cutting off trade, closing its airspace, and shutting its ports to Israel. The consequences are already rippling across global markets, and experts warn this could reshape not just Middle Eastern geopolitics, but also the global flow of energy and goods. So how far could this really go? Let's break it down. This begins with Turkey's sweeping announcement in August 2025. Foreign Minister Hakan Fidan confirmed that Turkey had completely severed trade ties with Israel. This wasn't just a symbolic gesture. It included a ban on Israeli ships entering Turkish ports, prohibition of Turkish vessels docking in Israel, airspace closures for Israeli government and military-linked flights, especially those carrying weapons. While commercial passenger planes remain unaffected, the restrictions sent an unmistakable signal. Turkey is willing to leverage its geography and trade corridors to punish Israel economically. This comes on top of earlier steps. Turkey had already scaled back exports to Israel in May 2024, a market worth nearly $7 billion annually. By the first half of 2025, Turkey's exports to Israel had already plunged nearly 72%, from $1.4 billion to just $393 million. But what makes this escalation so significant is Turkey's strategic position. Straddling the Mediterranean, Black Sea, and crucial land trade routes, Turkey is not just another country, it's a geopolitical gatekeeper. And now it's using that position as a weapon. The immediate fallout is visible in global shipping and logistics. With Turkish ports closed to Israeli vessels, shipping companies are forced to reroute cargo through Greece and Egypt. According to shipping trackers, this has pushed transportation costs up by 15 to 20% in just weeks. Insurance premiums have also risen as insurers factor in heightened political risk in the Eastern Mediterranean. Flights have not escaped disruption either. For example, routes from Israel to Georgia or Azerbaijan, normally passing over Turkish airspace, now require lengthy detours. In some cases, this adds up to 2 hours of extra flight time, straining airlines already squeezed by high fuel prices. The picture is even sharper at Israel's own ports. Container hubs in Haifa and Ashdod, already operating under stress from the Gaza war, are facing bottlenecks. Analysts report transshipment rollover rates, when containers miss their scheduled ship transfers, have jumped 27 to 47% above normal levels. Shipping delays are not just numbers. They mean real costs for businesses importing critical goods, from construction materials to machinery. And while Israel's economy has proven resilient, the delays feed into broader regional uncertainty. If trade disruptions sting, energy complications could prove far more consequential. At the heart of the issue is the EastMed pipeline project, a proposed multi-billion-dollar project designed to transport natural gas from Israel's offshore reserves through Cyprus and Greece, eventually reaching European markets. For Europe, this pipeline was more than just an energy deal. It was a lifeline to diversify away from Russian gas. But Turkey's restrictions now complicate logistics around the construction and deployment of pipeline equipment. With ports and airspace restricted, the transfer of heavy offshore rigs, subsea pipeline materials, and critical components faces new hurdles. Analysts warn that any delay in EastMed reduces Europe's ability to stabilize its gas supply, particularly as the continent still wrestles with the long tail of energy insecurity sparked by Russia's war in Ukraine. But it's not just about pipelines. Turkey's actions ripple through existing flows of oil and LNG. Turkey sits astride the Baku-Tbilisi-Ceyhan (BTC) pipeline, which delivers crude oil from Azerbaijan to the Mediterranean. While not directly targeting BTC, Ankara's flexing of maritime restrictions raises red flags for energy traders. Even the perception of risk can push prices higher, as markets tend to price in potential disruptions well before they occur. Already, the European diesel market has felt pressure. With supply chains rerouted and longer shipping routes required, diesel and petroleum product prices have surged, tightening margins for industries from transport to manufacturing. Energy projects thrive on predictability, but Turkey's actions inject uncertainty, making investors wary of financing long-term projects in a region where politics can shut down a $7 billion trade channel overnight. Analysts note that energy infrastructure is now seen as higher risk in the Eastern Mediterranean, potentially driving up costs and delaying projects further. So why would Turkey take such a drastic step, knowing it would face its own economic pain? The answer lies in Turkey's enduring ambition to act as a regional gatekeeper. By controlling trade routes, ports and airspace, Ankara reinforces its leverage as the bridge between Europe, the Middle East and Asia. This is not new. Turkey has long asserted maritime claims in the Eastern Mediterranean, often clashing with Greece and Cyprus over exclusive economic zones. The trade ban against Israel is not only about solidarity with Palestinians, it's also a demonstration of Turkey's ability to wield geography as a tool of power. Domestically, the move plays into President Erdogan's political narrative. By taking a strong stand against Israel, Erdogan appeals to a base that views Palestinian solidarity as both a moral and religious imperative. For the ruling AKP, such bold actions shore up domestic legitimacy, even at the cost of economic fallout. But the numbers are stark. Exports to Israel collapsed from $1.4 billion in early 2024 to just $393 million in the first 5 months of 2025. The Turkish lira depreciated 38% in 2025, amplifying inflationary pressures already burdening households. The BIST 100 stock index fell 15% in March 2025, reflecting investor anxiety. To defend its currency, Turkey's central bank had to burn through nearly $25 billion in reserves. In other words, while Ankara is asserting itself geopolitically, the domestic economy is paying a heavy price. On the surface, Turkey's ban looks like a heavy blow. But when you zoom into the numbers, Israel has proven remarkably resilient. According to the Bank of Israel, the trade ban has had minimal impact on the wider economy. Why? Because Israel's economy is built for flexibility. When Turkey cut off exports, Israeli companies quickly turned to alternative suppliers in Europe and Asia. Goods that once arrived through Istanbul or Izmir ports were rerouted via Greece, Cyprus and Italy. This agility prevented widespread shortages and kept inflation largely stable. The Israeli central bank explicitly reported in March 2025 that the embargo had little measurable effect on consumer prices. Energy, often the Achilles heel of geopolitics, has also remained secure. Israel's crude oil imports from Azerbaijan continue to flow through the Baku-Tbilisi-Ceyhan pipeline, which passes through Turkey but remains unaffected by the trade bans. That's crucial because roughly 40% of Israel's crude imports come from Azerbaijan. As long as Ankara doesn't tamper with this artery, Israel's refineries stay supplied and domestic fuel prices remain insulated from Turkey's pressure. Israel has also shown its adaptability in smaller ways. Take the tugboat deal when a $30 million order placed with a Turkish shipyard was suddenly jeopardized by Ankara's embargo. Israel simply redirected the order to a Bulgarian shipyard. This small but telling example illustrates Israel's broader strategy. Don't fight the ban head-on, circumvent it. By diversifying, rerouting and reordering, Israel is managing to minimize the sting. But while Israel can adapt, the broader world may not be so lucky. With Turkey out of the equation, trade flows in the Eastern Mediterranean have been disrupted. Cargo that once moved swiftly between ports now faces detours through Piraeus in Greece or Alexandria in Egypt. This means longer delivery times, higher costs, and more strain on already fragile global supply chains. In Israel's ports, container rollover rates jumped by 27 to 47%, leading to delays in everything from electronics to raw materials. Global shippers report that insurance premiums for Eastern Mediterranean routes are climbing, reflecting the region's heightened risk profile. For global energy markets, the uncertainty around the EastMed pipeline and Turkey's maritime choke points introduces volatility. Even though no barrels of oil have stopped flowing, the perception of instability drives prices higher. Energy traders price in risks ahead of time, meaning companies in Europe and Asia are already paying more for diesel, LNG and other fuels. Europe in particular is watching closely. Having scrambled to reduce its reliance on Russian gas, Europe now finds one of its alternative sources, the Eastern Mediterranean, embroiled in fresh geopolitical tension. The ripple effects extend into financial markets. Energy and infrastructure investors are now treating projects in the Eastern Mediterranean as high-risk zones. According to market analysts, financing costs for regional projects have risen as lenders factor in the risk of political shutdowns like Turkey's embargo. This risk premium makes it harder for projects like offshore gas rigs or subsea pipelines to attract capital. In other words, Turkey's ban is not only delaying current projects, it's casting a shadow on future investment flows as well. And here lies the paradox. Turkey intended its sanctions to hurt Israel. In practice, the broader disruptions, higher shipping costs, volatile energy markets, and skittish investors may be hurting global systems more than Israel itself. Turkey's trade ban against Israel is more than a diplomatic quarrel. It's a demonstration of how a single country, by closing ports and air routes, can send shockwaves through global commerce and energy markets. This isn't just about Turkey and Israel. It's about how fragile global trade routes have become, how energy security can be undermined by politics, and how investors must navigate risk in a world where geopolitics can rewrite shipping maps overnight. The story of Turkey's ban underscores a larger truth. In our interconnected economy, regional disputes never stay regional for long. So the question remains, if one trade ban can ripple across continents, what happens if the Eastern Mediterranean becomes the next great flashpoint of global politics? That's the story still unfolding. What do you think? Could Turkey's strategy backfire, or will it reshape global trade and energy for years to come? Let us know your thoughts in the comments below. You are watching Cross World News.